and it's actually pretty logical, right? The moment you have guarantees, then the pattern of investment changes. You end up doing a safer investment options. You end up doing more of government bonds, and you would trade lesser in equity. And you would, in general, a guarantee does end up with a slightly lower return. The probability of it exists. Okay, I'm going to flip this around, and Leo comes with years more of experience, and I come in awe of him because Sridhar just gave me a lot of background about you. So I'm going to leave this to a debate, but I'm going to turn around and say, if guarantees are really so bad, okay, why is the government, or rather the other way around, why is the government not taking up guarantees any longer? If you look at pensions, guaranteed pensions have stopped. The central government, state government, any of these companies which used to have guaranteed pensions, they no longer offer pensions. That's because the risk of guarantees is actually something that can make an economy go down. And we've seen that in several other markets as to how that can happen. So what you're in effect doing is saying that I as an organization, I as a government, will not carry the risk of guarantees. You as a customer, irrespective of whether you are educated, not educated, literate, and when I'm saying educated, not educated, I don't mean it from a technical degree, I mean it from a financial literacy. And the most highly educated specialist doctors can be financially illiterate. So, so I would like to place that very firmly. But the government or the institution says that, the risk of not being able to deliver X amount of return, Mr. Customer, I want you to bear it because I want to be safe. So, if I just have to turn it around, that's a way of looking at it, right? And I find that conceptually not acceptable. As an individual, if I don't have skill sets, is there no organization I can trust to say that will you be able to guarantee? Now, can you have variations in the guarantee? I think that's a must. Can you do you not have to guarantee upfront that for the next 25 years I'm going to be paying you an X% return? Yes. So can you have guarantees which are more in smaller bite sizes, maybe a 5-year bite size or a 10-year bite size based on how the economy is going? And can you have a guarantee which is linked to maybe a GSEC return or maybe any other benchmark return? But I believe guarantees force institutions to take responsibility for managing it in a manner that the customer does not have to share the burden. I believe that when you don't give guarantees, you're being lazy, and it is.
Okay, Sumit, what's your take? Because the PFRDA Act allows for guaranteed returns. So far, the pension fund managers have stayed away from guaranteed returns. So you tell me, for a pension long-term product, do guarantees make sense? And if you're not guaranteeing return, are you lazy?